Welcome to our webinar looking at pension schemes and the considerations of going concern in the current economic climate. My name is Liz Story and I am an Audit Director in RSM's London office. I am joined in this webinar by my colleague Helen Hord, who is an Audit Director in our Tunbridge Wells office. During this webinar, we will be looking at why going concern should be on the minds of trustees and what that means in terms of their interaction with their auditor on the subject of going concern. Based on our recent experience of signing off pension scheme audits, we will be offering some practical advice for what trustees should be doing. So, to start off, why is going concern an issue for pension schemes? The Pension SORP, published in 2018, acknowledges that going concern does not have the same significance for a pension scheme as it does for other entities. However, the appropriate basis of preparation and relevant disclosures should still be carefully considered by both the trustees and the audit team. As a reminder, the SORP tells us that a scheme is accounted for as a going concern unless the trustees or employer have taken the formal decision to wind up the scheme or have no realistic alternative but to do so. For example, where there has been a cessation event, and these are normally set out in the scheme's trust deed and rules. However, the SORP also requires that where trustees are aware of material uncertainties related to events or conditions that cast significant doubt on the scheme's ability to continue as a going concern, then the trustee shall disclose these uncertainties, for example, if the scheme is in a PPF assessment period. Guidance provided to the pensions industry by PRAG, the Pensions Research Accountants Group, in 2018 suggests that a material uncertainty may arise where the employer is experiencing financial difficulties, but the directors regard the business as a going concern as they are seeking to resolve those difficulties, for example, through renegotiating banking covenants or refinancing their obligations. The SORP requires consideration not only of whether a decision has been taken to wind up the scheme, but also being faced with no realistic alternative to doing so. With the impact of COVID-19 upon the ability of businesses to operate, trustees must now be thinking about the wider implications for their scheme resulting from their sponsor's position, rather than, for example, just the immediate ability of the scheme to meet its own liabilities through changing cash flow management processes. RSM recommend that trustees are looking at the following specific risks insofar as these impact upon the scheme and the position of the sponsoring employer, and the increased risk that the scheme might enter into a PPF assessment. Is the sponsoring employer at risk and unable to make deficit funding contributions, or are these being reduced as they cannot be paid in full? Is there a significant deterioration in the scheme's funding position due to changes in the market, increasing the size of necessary deficit funding contributions, which in turn puts increased pressure upon the sponsoring employer or changes the trustee assessment as to the outcome of any PPF assessment period due to the worsened funding position? If the scheme is reliant upon cash flows from the employer to cover scheme outgoings, do the trustees have access to liquid investments in order to meet pension and other liabilities as they fall due? What about if there are trading curbs or fund suspensions on their investments? And does this mean that everyone is in the same position? The short answer to that question is no. Trustees may reach very different conclusions for their going concern assessment, depending upon their own specific circumstances, and this will depend upon different factors, such as what's the investment portfolio and the strategy. A well-hedged fund may have seen a much more limited impact from the recent changes in the markets. What's the nature of their sponsoring employer and their ability to meet contribution payments as they fall due? Some industries, for example travel or hospitality, are likely to be significantly more affected than other industries. What about the timeliness and availability of government support to their sponsoring employer? Again, this will be different depending upon the sponsoring employer. What are the trustees' expectations for member movements and resulting benefit payments in the 12 months from sign-off of the accounts, and their ability to meet those payments with liquid resources? In terms of the day-to-day operations of the pension scheme, What contingency plans do the trustees and administrators have in place to ensure that benefit payments, etc., continue to be made on a timely basis? And what are the trustees' intentions and plans in terms of their scheme? Clearly, the situation is entirely fluid, and so trustees should be alert to any changes and any new guidance published by the regulator. Going concern will not be a one-time consideration, but instead will need to be monitored and updated on a regular basis. It is the responsibility of the trustees to conclude whether or not their scheme is a going concern, and this must be documented, and the evidence used to reach that conclusion should be made available to the scheme auditor. If the trustees have concluded that the scheme is a going concern and there are no uncertainties within their considerations, and the audit team have supporting evidence for this conclusion and agree with it, no further action is needed. If the trustees have concluded that the scheme is a going concern and there are uncertainties but these are not considered to be material, then the uncertainties may be included in the basis of preparation note to the financial statements, but no highlighting reference is required by the auditor. Finally, if the trustees have concluded that the scheme is a going concern and there are material uncertainties, for example, the trustees are aware that the sponsoring employer is facing difficulties in renegotiating banking facilities that would impact the employer's position, then these material uncertainties need to be included in the basis of preparation note in the accounts. In the audit report, the auditor will draw the reader's attention to this uncertainty, but will also conclude that the scheme is a going concern and the report will be unqualified. The auditor will still need to obtain and consider the supporting evidence for this conclusion. All of this relies upon the trustees performing their own assessment of going concern and then providing evidence to support their assessment and conclusions. If the trustees are unable to provide this evidence to the auditor, then a qualified audit report may be required. So what do trustees need to be doing? If they aren't already looking at their scheme's position, then trustees need to be aware that their scheme auditor is going to want to be discussing going concern and will want to see evidence to support any conclusions reached by the trustees. We've put together some suggestions for actions that trustees could be taking. Trustees should be in regular contact with the sponsoring employer to determine what position the sponsoring employer is in. There should be conversations about contributions and any changes to the pattern or amount of contributions being paid to the scheme, and it would be appropriate to involve the scheme actuary in these conversations for DB arrangements. What about if there are changes to salary levels, perhaps due to furloughing? Trustees need to continue to monitor the completeness and accuracy of contributions against the schedules of contributions and the payment schedules in place. For DB arrangements, if changes are being made to the deficit reduction contributions, trustees should be considering whether or not to amend the schedule of contributions so that this is a formal arrangement. There will be implications for the auditor's statement about contributions if contributions are not made in accordance with the agreed schedule, so it may also be appropriate to engage the auditor in these conversations. Trustees should be reviewing their cash flow policy. Does it need changing in the light of a change in pattern of cash flows from the employer? For example, if deficit reduction contributions cease and those usually cover the pension and payroll, where is the money going to come from instead? Finally, many DB schemes have in place significant buy-in policies, longevity swaps or similar arrangements, or schemes may have significant individual pension annuity policies in the name of the trustees. Where these are held, trustees should be considering the operational resilience, credit arrangements and regulatory structures of the providers and counterparties to consider the impact of COVID-19 on these arrangements. I'll pass over to Helen now to talk through some recent practical examples of going concern considerations for some of RSM's clients.
Thank you, Liz. So having thought about what the guidance says, I wanted to share with you some examples of schemes where we have signed off the audit report. Now, if we look back here at the slide Liz showed earlier, there are a number of scenarios that might arise in terms of the trustees' conclusions around going concern. Most commonly, we're seeing the first three situations in schemes, which we have signed off so far, which you may well expect. In fact, the treatment within the first two scenarios is relatively similar. and there are probably few schemes who can say that there are no uncertainties at all in the current climate. But even where there is little or no uncertainty, there will be different situations, such as the differences between a DB or hybrid scheme and a purely DC scheme. In all cases, as Liz has previously mentioned, there has been a requirement for our clients to provide us with more detailed assessment of the trustees' considerations in respect of going concern. Trustees in some cases have found it difficult to understand the level of extra details we need on this, so we hope that by sharing some examples we can make this easier for trustees to understand. So let's first consider examples of sign-off of a DB scheme with no modification. Example 1 is a scheme which required no contributions in the next year. It was well funded at the last valuation, but the next valuation has an effective date in 2020. The trustees concluded that the scheme was a going concern as it had sufficient assets to meet the pension obligations and there were no contributions due. We held a discussion with the trustees to understand in more detail why they were satisfied around the ability of the sponsoring employer to continue to support the scheme, despite the fact that there were no contributions due. The trustees were able to provide evidence that the customer base of the sponsoring employer had not decreased since the onset of COVID-19, and also that they had received payment for 80% of their outstanding invoices. The employer also had a significant asset base. They provided forecasts to us for the next 12 months, and they also demonstrated that conversations had been held between the employer, and it had been agreed that, although not required by the schedule of contributions, additional contributions were to be paid to the scheme for a period of 3 months initially, and this was to allow pensions to be paid without the need for the scheme to disinvest at a suboptimum level from the investments that they held. Given the effective valuation date is in a few months' time, and there was evidence from the scheme's access to liability monitoring software that the scheme's deficit would be increased as a result of COVID-19. Albeit, the trustees' strategy to invest in matching assets meant that the increased deficit was not as much as it could have been. In this example, we can see that there was clear communication between the trustees and the employer, and that the employer was able to share detailed results and projections to demonstrate that the overall impact to the employer was fairly limited. The additional contributions in this particular example were not needed for the going concern assumption to be valid, and are just an example of effective communication between the scheme and the employer. Other schemes which I've signed off on the same basis have drawn down from cash-based assets, for example, so that the scheme is not affected detrimentally by a poor disinvestment rate, and have demonstrated their communication in other ways. As an audit team, we considered the factors that Liz mentioned in asking the trustees to reach their conclusions, and asked the trustees to provide evidence in their conclusions in each area. So these included the investment portfolio and strategy, the nature of the sponsoring employer, the timeliness and availability of government support for the sponsoring employer, trustees' expectations for member movements, and day-to-day operations of the pension scheme. From my experience of discussing this with various trustees on a number of schemes, the key decision for trustees seems to have been around the nature and industry of the sponsoring employer. That's not to say the other factors are less important, it's just that for most of my schemes, the other aspects appear to have been more within their control. For example, in terms of a well-hedged portfolio, or liaison with the administrator to ensure that the day-to-day operations are continuing as expected. Once sufficient evidence had been obtained from the trustees, we were able to sign off the accounts without modification to the audit report. Additional disclosures were needed in the trustees' report and the accounts in respect of a PBSE, that's post-balance sheet event, of COVID-19. We also suggested additional disclosure in the basis of preparation paragraph to demonstrate the going concern assumption remained appropriate. This slide shows an example of the kind of wording which may be added in this situation. For the scheme that was receiving additional contributions, reference was also made in this paragraph to those contributions, but it should always be tailored to each client. So sticking with the assumption that the scheme is a going concern with little or no uncertainties, but this time with a DC focus. Well, the situation for purely DC schemes is slightly different, but the going concern assumptions do still need to be considered. Obviously, there's no deficit, and any downturn in investments adversely affects the member rather than the scheme itself. There's no monthly mention of payroll to worry about. So what more do trustees need to think about to satisfy the auditors that the scheme is a going concern? The first consideration is whether the scheme has seen any impact on the monthly contribution cycle since COVID-19. If contributions are being made as standard, then the next factor to consider is the status of the sponsoring employer. Have the trustees held conversations with the sponsoring employer? Does the employer intend to continue to support the scheme? These discussions should be documented for the auditor to consider. Is there a business continuity plan in place? Details of the trustees' strategy for dealing with the continuity of the scheme will also provide the auditor with useful evidence to support their conclusions. Are there unallocated funds which can be used to fund contributions if there is any financial uncertainty with the employer? And what period of time would they cover? And is there any longer term plan, perhaps to move to a master trust? Has COVID-19 accelerated any previous plans? The key here is the conversations with the sponsor and the trustees' documented evidence of these discussions, as well as the trustees' overall strategy and consideration of business continuity. Example 3 is a scheme where we again were able to get very positive engagement from the trustees around their discussions with the employer. The sponsoring employer had suffered as a result of COVID-19. Steps have been taken to secure the income from their activities on a more digital basis, and forecasts had been drawn up using scenario planning of different situations to consider the viability of the sponsoring employer and their ability to continue making contributions. In this situation, while all the steps the employer has taken are sensible and demonstrate innovation in their field, as auditors, we have to demonstrate our professional scepticism and consider that the employer's best intentions may not secure the future of the business. And whilst the trustees note that contributions are being received as normal currently, and pensions are being paid, and the scheme has plenty of assets, as you would expect from most schemes, those assets are intended to cover a longer period. The deficit has increased, although again an element of liability-driven investments ensures that this is minimised. Fundamentally, there is a material uncertainty which exists within the scheme as a result of COVID-19. Once again, we can see here that the key decision for trustees seems to have been around the nature and industry of the sponsoring employer. And in this situation, whilst the scheme has control over other aspects of these matters, the nature of the employer cannot be altered. So what does this actually mean for the pension scheme? Well, in this situation, the accounts are still prepared on a going concern basis. An additional wording will be required in Note 1 and in the trustees' report and accounts regarding the post-balance sheet event around COVID-19. The forecasting produced by the sponsoring employer and shared with us was reviewed, and as auditors we queried certain key assumptions. We also considered those principles which I mentioned in my first example. Our conclusion in this situation was that the going concern assumption is appropriate, but that an uncertainty exists. An example of the kind of wording included within the audit report is in this case shown on the slide. You will note from the wording that we specifically say our audit report is not modified in this respect. I've also included an extract from the additional wording in Note 1 referred to within the audit report. Again, you will note that the trustees consider the scheme as a going concern, but that there is a material uncertainty around the ability of the sponsoring employer to maintain contributions at the required level for a period of at least 12 months from the point of sign-off. So we have now looked at 3 examples which cover the first 3 scenarios. We would always look to work with our clients to explain the evidence we need so that appropriate audit conclusions can be drawn. And hopefully, having shared some examples with you, it is easier for trustees to understand the types of information we need to support those conclusions. It is worth noting that the examples shared are for September or December year ends. For March year ends onwards, a post-balance sheet event note is unlikely to be required, as COVID-19 was a known event at that point and may already have affected investment values. The trustees may still wish to include some wording within the trustees' report to provide clarity on the situation. The additional disclosures to be included should always be discussed in each situation with your auditor, so that appropriate disclosure can be made, which is relevant to your particular scheme. It is also likely that your auditor may have to agree the disclosures with their technical department before final wording can be agreed. Thank you for listening. I hope you have found the webinar useful. If you have any questions, then please get in touch with Liz or me or your usual pensions audit contact. Thank you.